Hi everyone. In this video, I'm going to be giving you an investment sales market report for Greenwich Village, West Village, and the Meatpacking District. The reason I chose these three neighborhoods is these are the three neighborhoods that I focused my business in for real estate. So for the past few years, I've been tracking the market here to see what things are selling for and also what things are renting for in the area. So if you have any questions about any of that, please let me know. For this market report, I took a look at investment sales activity that has occurred for the first 3 quarters of this year, so in 2020, and I'm comparing it with the same period last year, so quarter 1 to 3 from 2019. I created a PDF copy of the market report, but I wanted to make this video to supplement that, where I just elaborate on the numbers that I found in the report, and I also talk about why I believe the numbers are the way they are and where I see the market going in the future. The first key takeaway that I found and included in this market report is that the number of investment sales transactions is down 62.5% from the same period last year. So from the first to the third quarter of 2019. Also, in addition to that, dollar volume is down 72%. During the first 3 quarters of 2019, there were about $1 billion in deals done spread across 24 transactions, averaging about $1,820 a foot. During the first 3 quarters of this year, there were 9 sales totaling about $280 million and averaging $1,560 a foot. What's interesting is if you look at the number of deals that were done this year, so 9 deals done this year, the bulk of those deals were done in the first quarter, from January through March. There were 6 transactions, 6 of the 9 transactions were done in the first quarter, totaling $242 million. The remaining 3 were transacted post-COVID, post the COVID shutdown here in New York City. Now, if we compare that to the first quarter of 2019, you'll see that investment sales activity was actually starting to pick up later in the year and into the first quarter of 2020. In the first quarter of 2019, there were 6 transactions, so the same amount as this year in 2020, but there was a lower dollar amount. Those 6 transactions totaled $47 million in the first quarter of 2019, and the 6 transactions for this year totaled $242 million. That in of itself doesn't tell the complete story of why transactions were picking up. Last year altogether, there were 30 transactions, so an additional 24 transactions after the first quarter for a little over $750 million, almost $800 million in transactions for the remainder of the year. Now, I have to back up a little bit because, as I stated, there were 6 transactions done this year in 2020, just in the first quarter, totaling $242 million. However, 2 of those, there were 2 big outliers. The first was a $75 million office deal that sold in the West Village, and the second is a student housing deal that sold for $104 million. But even without those deals, in the first quarter, you still had 4 other transactions that sold for a total of $63 million. So for those 4 transactions, there were 3 mixed-use buildings and a retail condo. They sold for higher than the 6 transactions total that sold in 2019. After the COVID shutdown happened, then there were only 3 remaining sales for this year between the second and third quarter. And those were all mixed-use deals that totaled about $36 million. So overall, the market in these areas starting in 2019 started to improve, started to get better. We started seeing more activity, and that continued into this year, into 2020 in the first quarter. But as you can see, once COVID happened and it really broke out in New York City and we had the shutdown, that took a huge hit on the market in these neighborhoods, causing the market to just nosedive after that, with only 3 sales since that happened. Now let's take a look at specific asset classes and how they performed in these neighborhoods. We'll start with multifamily. When I say multifamily, I'm talking about apartment buildings that have 5 or more units and are strictly multifamily, just apartments, only residential, no commercial spaces, no ground floor retail. During the first 3 quarters of 2019, there were 5 multifamily transactions that sold for a total of about $59 million at an average price per square foot of $19.16 a foot. Now, I know almost $2,000 a foot for multifamily sounds like a lot. There were some outlier deals that happened where a few buyers, they paid over $2,000 a foot. There was actually one building on Bethune Street that sold last year in January for almost $2,800 a foot. Those are the outliers. I did include that in the market report, but you have to take into account that that's not the norm, especially if your building is rent stabilized or rent controlled. For these vacant, smaller free market buildings, some people bought those so that they can convert them to smaller, either single family homes, because you can do that with R6 zoning, or even a 2 or 3 family if someone wants to break it up and live in one of the units and rent out the other 2. Usually buildings with 1 to 4 units, they sell for a higher price per square foot than just regular apartment buildings, your 20 unit, 30 unit apartment buildings. But that being said, this year in the first 3 quarters, we've had no multifamily trades in the area. Part of the reason that I think this is that I think sellers are still adjusting their pricing expectations for multifamily, especially ones with rent stabilized and rent controlled apartments after the new rent laws that passed last June. I also think for sellers of free market buildings or sellers who want to sell their free market buildings, there's a delay because they're trying to make sure they have their paperwork in order to show that the units were destabilized correctly before going to market or before actually transacting. So I think that's what caused the delay in multifamily transactions happening in this area, at least for the first quarter of this year. Another reason why I think that we don't have any multifamily transactions in this area so far this year is because of COVID. Since COVID and the shutdown and just the pandemic in general, a lot of investors are sitting on the sidelines waiting to see what is going to happen. They want to see where rents are going to stabilize at. I know right now in Manhattan in general, there are a lot of apartment vacancies, and that includes the Village. So some investors are trying to wait until that stabilizes in order to get back into the market. Others are willing to get into the market and buy these buildings, but at a steep discount that many sellers aren't willing to take. I think the only transactions that we're going to see going forward are people who are either highly motivated to sell, they have to sell, or people who have a plan for selling and then doing a 1031 exchange into another building, whether it's another asset type or even another location. And I also think you'll have some sales, maybe not this year for the remainder of this year, but maybe next year, early next year, if things don't get much better. I think we'll have some sales from sellers who have held long-term, but just want to cash out just in case things get a little worse, or they might have the belief that, or the feeling that they just don't want to go through another cycle. So I think that's what we'll see for multifamily, and I think even every other asset class. Now continuing on for multifamily buildings, transitioning into mixed-use buildings, so buildings that have apartments on the top floors and then retail or a restaurant on the ground floor. Let's take a look at that market. During the first 3 quarters of 2019, there were about $164 million of transactions spread across 13 buildings. Those averaged out to about $1,566 per square foot. Now comparing that to the first 3 quarters of this year, in 2020, there were 6 mixed-use building transactions totaling just under $90 million and averaging about $1,405 a foot. The reason that I think that there are less mixed-use building transactions this year than there were during the same period last time, are similar to the reasons I gave for multifamily, because you still have apartments, some of which are rent regulated. But also in this asset class, now we're dealing with more commercial tenants. We have ground floor retail tenants, we have restaurants and other small businesses who are operating out of these spaces. Those tenants were hit even harder than the residential tenants in the neighborhood. Many of the residential tenants are still paying rent, they're still on time, they still have their jobs. Many of them are just working from home, so they can still afford it. These small businesses and restaurants and other ground floor retail tenants are the ones who were affected even more from the shutdown, because they lost a lot of revenue from not being able to be open or being open at a much lower capacity. Because of that, many of those tenants are not able to pay full rent, if any rent at all. In a survey sent to about 500 restaurants and bars across New York City, 87% of them said that they couldn't pay full month, their full rent. And then about 34% of those respondents said that they couldn't afford to pay any rent. On the flip side, for residential tenants during the same period, I've been seeing reports of only 10% of tenants, or even maybe up to 15% of tenants being in arrears, versus almost 90% for commercial tenants. Due to the higher level of arrears among commercial tenants, ground floor commercial tenants, I think that these properties are viewed as riskier asset classes by investors. So unless sellers are discounting their properties to meet the market, I think that we'll continue to see a slowdown in the amount of transactions that are being done in them. However, for mixed-use buildings, since you do have apartments as well to hedge against any retail vacancy that you have, I think you'll still see those transactions still at a lower rate. I think all asset classes are slowing down in terms of transactions, but if we're talking mixed-use buildings that have apartments and retail versus strictly commercial buildings, I think mixed-use buildings are going to do better in terms of sales volume and price as well. Speaking of commercial tenants, let's take a look at how the asset classes that are strictly commercial are performing now versus how they were during the same period last year. Last year, there were about $21 million in retail transactions spread across 3 deals, averaging about $2,821 a foot. During the same period this year, in the first 3 quarters, there was only 1 retail deal done for $10 million, which was about $2,700 a foot. One thing to keep in mind with that is the retail deal that was done this year was done before the COVID shutdown. There haven't been any strictly retail deals done since then. And looking at the office market, last year there were 2 really big deals done in the Meatpacking District, totaling about $721 million, which was a little over $2,100 a foot. One of those deals was Google's almost $600 million purchase of the Milk Building on 15th Street in the Meatpacking District. Comparing that to this year, there was only 1 office transaction that happened, and that was back in January on Leroy Street in the West Village. And the other deal that I have categorized under commercial or office plus other commercial, is the student housing deal, which was for $104 million. So in total, categorizing these 2 deals under the same asset class, you have about $179 million in deals, and they average just under $1,500 a foot. So you see, last year we had a couple of much bigger deals happen than this year for the office asset class. The last asset class that I discussed in the market report is development. This year there were no development sites done, but last year there was only 1 development site that sold in the area, and that sold for about $760 a foot for a total of $30 million. In regards to development sites, I think that we'll continue to see a very low number of deals getting done, if any get done. And I think that's due to the lower demand that we have for more development in the area. There's a large supply of apartments that are on the market for rent and condos that are for sale. So there's not really a need for that in the area. Also with office space, right now a lot of people are still working from home. So office or businesses don't need as much office space as they needed previously. However, I think for the ones that are currently under construction, because there are a decent amount of sites in the area, they might not be like right in the heart of the village, but in the Meatpacking District and on the outskirts, there are a lot of larger offices being developed, including Google, who's developing St. John's Terminal, which is going to be about 1.3 million square feet of office space for them. Disney is also in Hudson Square. They're developing over 1 million square feet of office space for a headquarter office there. You also have Google, who is right off of Meatpacking at Pier 57, and they're going to have about 600,000 square feet of office space there, as well as in the Meatpacking District and Chelsea with their purchase. Actually, they bought the old Chelsea Market building for over $2 billion. So they'll have a lot of office space there as well. So you'll see a lot of the tech companies doing that, buying and building out office spaces. But as far as sales to sell to a developer to build more spaces, I think that'll continue to be slow. That was my market report for Greenwich Village, West Village, and the Meatpacking District. But before I end this video, I do just want to talk a little bit about what has been going on in the market and what I see happening. In general, in New York City, the investment sales market is very slow right now. And that's understandable. There's a lot of uncertainty in the market right now. And no one really knows where we are in terms of if values have bottomed out or if we're going to start an uptrend going back up and if the market's going to start to recover. But that being said, for any investors who are sitting on the sideline waiting for the market to bottom out and waiting for values to be as low as they can be before you buy, I would reconsider that, because if you think about it, anyone who bought at the bottom of the market, they didn't know they did. By the time you know the market has bottomed out, it's already going back up. So for anyone who is second guessing whether or not this is a good time to buy, keep that in mind. Also, as Warren Buffett always says, you want to buy when others are fearful. This is a time when many investors are fearful or just being extremely cautious because of the uncertainty in the market. However, especially in these neighborhoods, if you own an apartment building in the West Village, mixed-use building, any kind of asset class in this area or even in other good areas, long-term you will do well. So you have to be long-term thinking. And just in general, you see how much prices have gone down. This is a good time to buy. It's a better time to buy than it was a year ago. On the flip side, for any potential sellers, I always say, if you don't have to sell, don't sell. Especially in a market like this, you want to hold off until it gets better. However, there might be some other reasons why you really want to sell right now. One of those reasons could be that you just want to cash out now. You think the market might get a little worse, which no one has a crystal ball. We don't know. It could happen. And maybe you just don't want to go through these cycles anymore. But then another reason could be because you want to reposition your portfolio. Maybe you have a building or a property that is in your portfolio that doesn't really fit well in it, and you want to sell it and 1031 so that you defer your taxes into another asset that does fit better. That could make it a good reason to sell. And if you think about this, if you sell something now, you might sell at a lower price, but on the flip side, the property that you exchange into, you're going to buy that at a lower basis as well. So it'll balance out that way. So I'll leave you with that. If you enjoyed this video and you found it helpful, make sure you give it a thumbs up. and share it with anyone who you think would also find it helpful. Also subscribe to my channel for more, and I'll see you in the next one.